Welcome to the 3 Edge Week in Review for the week of May 17th, 2021. I'm Fritz Folts, Chief Investment Strategist at 3 Edge, and I'm joined here today by Steve Cucchiaro, President and Chief Investment Officer of 3 Edge Asset Management. And today, along with a brief update of the global capital markets, Steve and I will be discussing the topic of stagflation. First, a brief market update. And it seems like markets are in the mode of one step forward, one step back, another step forward, another step back, and constantly driven by headlines of the day. At the beginning of the week, a dramatic decline in the digital currencies seemed to bleed into the equity markets, triggering a pretty good risk-off decline. Concerns over the digital currency space were accompanied by investor fears that the minutes from the Federal Reserve's latest policy meeting indicate that some members of the Fed have begun to raise the possibility of beginning to ratchet back the $120 billion in bond purchases that the Fed continues to make each month. But then later in the week, markets got some support from a report from the Labor Department indicating that new applications for unemployment assistance fallen to a pandemic-era low. However, then on Friday, Bitcoin took another hit, this time from the Chinese, who reiterated their warning that they intend to crack down on cryptocurrency mining as part of an effort to control financial risks. And of course, on Friday, the Philadelphia Fed president was quoted as saying that the Fed should discuss reducing their bond buying programs sooner than later. And there are lingering concerns about the prospects for future inflation. It is during weeks like these that I am very glad that we're able to rely on the discipline of our 3 Edge global capital markets to inform our decision making. So Steve, as we have discussed, and in fact we discussed last week in our video, there is increasing concern among investors about the prospects for rising inflation. However, there is another potential risk that has not been discussed as much, and that is the prospect of stagflation, where you get the elevated level of inflation, but you don't get the commensurate economic growth. The stagflation that probably is most etched in investors' minds, at least those of us old enough to remember, harkens all the way back to the 70s and the period of the Arab oil embargo. And we can remember mile-long gas lines, double-digit increases in CPI, and actually painfully high levels of unemployment. So currently, we're having temporary increase in inflation. For now, the employment rate, although it's coming down, is still kind of high, and economic growth is rebounding sharply. What would be the circumstances from here, from where we are now, that would bring that could bring on a period of stagflation?
Well, it's certainly not destiny that we need to go to stagflation, but the possibility is higher than what the financial media or what economists or what investors are focused on. So I think it's really important to take a look at this. There are two distinct schools of thought about where the economy is heading right now. One school of thought is what the Fed has been articulating, which is, yes, we do have this temporary spike in inflation and growth, but it's only temporary. It's all going to come back down and we'll go back to a lower growth, lower inflation mode. Another very distinct school of thought is, no, this is more permanence to it, that inflation is just in the early stages of a higher level. And growth will really benefit from the massive monetary and fiscal stimulus that's already put in place, and also more that's being discussed. So what happens if each school of thought is half right?
Right.
Let's say that because the Fed has been so late, based on their normal practice of trying to preempt rising inflation, they've already said they're not going to do that. They're going to wait as long as they possibly can. Let's say that they're behind the curve, they're late to the game, and we do get inflationary pressures rising, much like what happened in the early 70s when the Fed was behind the curve at that period. At the same time, what happens if the other school of thought is half right, in that the demand from the driven by the stimulus checks runs out when the stimulus checks run out and the unemployment benefits run out, and we go back to the slower growth at the same time? We could have a higher inflation, slower growth. That is stagflation.
Very good. So I have referred back to the stagflation that was in the 1970s and how it was related to the Arab oil embargo at that time. And that's an example of a supply shock actually enacted by the oil cartel. So I guess a question that I have is, could the coronavirus or a global pandemic, could that serve as some kind of a shock that would also could help bring on a period of stagflation? Is there anything embedded in the coronavirus itself and then the emergence from the virus that could lead to stagflation?
I think it's helpful to think of the coronavirus and its impact as the catalyst for a turning point or regime shift in the global economy and the markets. And before COVID, you had a certain set of rules, certain set of investment strategies that worked very well. And I believe we'll continue to find that post-COVID, we've had a regime shift. We will now be having different behaviors, and different investment strategies will succeed, not necessarily the ones that succeeded beforehand. You talked about oil supply shortages in the 1970s. Well, we're having a series of shortages now. A big one are in semiconductor chips. Major problem because so many industries, from automotive to defense to technology, many industries are dependent on semiconductors. And the problem is that as the demand has risen greatly, the supply takes a long time. You have to spend years building these plants and capital equipment till the supply can go up. Building materials, we've had supply shocks with building materials. There are builders who now won't even quote prices because they don't know what they'll have to pay for materials. And other commodities are seeing supply shocks. And so those are certainly reminding me of what it felt like back in the 70s when we had oil shocks. And also back in the 70s, it was really caught everyone by surprise how inflation crept up, first slowly and then more strongly. And in that surprise, the government tried to institute price controls, but they didn't work. They failed miserably. They didn't control the inflation, and they discouraged producers from adding to new supply, only making things worse. Well, just a few days ago, we heard that the Chinese are considering adding price controls to commodities, and they're very concerned about the rising commodity prices. We also think that won't work. So we think that we're in a situation where COVID triggered a series of changes, and now looking forward, we can see an environment where inflation is more sticky, but growth might be what's transitory, not inflation.
All right, then here's the big question. If stagflation should take hold, where you get this period of higher inflation yet slower economic growth, what would be the implications for investment strategy? Because it certainly sounds like a difficult investing environment to have to navigate.
We think a lot of investors will be caught off guard if, in fact, we get to stagflation. We haven't had stagflation in any meaningful way for over 45 years. And a lot of investment strategies have been created since then and not looking very hard at what happened during the 70s. But if you go back to the 1970s, the inflation during that decade really hurt bond investing tremendously. You actually lost money investing in bonds as the principal value of your bonds declined when interest rates climbed, chasing the inflation rates. Equities had a very difficult time. There was tremendous volatility. There were some bear markets, like in the 1974 period, where the market fell over 40%, and then it would rebound and fall again. And the equity markets went up and down a whole lot, but really didn't change much between the late 1960s and the early 1980s. So a very difficult environment for a strategy that just focuses on stocks and bonds. But the one asset class that did tremendously well during stagflation were real assets. Gold soared because it reflected the fact that the US dollar and paper currency was suffering because the Fed was always behind the curve. They were never catching up to inflation. Interest rates they set were always below the inflation rate. It didn't pay to stick in paper currencies. It paid to stick in hard assets like gold. And then commodities benefited from some of the supply shocks. And so we are already positioning ourselves so that if stagflation does take hold, our portfolios have more than the typical amount of gold in commodities and in general real assets. So I think we're well hedged against that possibility or risk.
Excellent. Great. So that will do it for us. Steve and I will be back next week, another edition of the 3Edge Weekend Review. All of our videos are available on our 3Edge YouTube channel, as well as on our website at 3edgeam.com. And if you'd like to submit any questions or make any suggestions for future topics, we would love to hear from you. And all you need to do is write to us at weekinreview, one word, weekinreview at 3edgeam.com. So until next time, on behalf of everyone here at 3Edge, have a wonderful and restful weekend, and thanks for listening.